This is TreppWire Week in Review for week ending March 11th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, the U.S. bans Russian oil, and the House passes a $1.5 trillion spending bill that includes aid for Ukraine. Markets were on a wild ride again, reacting to oil prices that topped at $130 per barrel before dropping again, and the consumer inflation number for February, which hit a 40-year high. And an unprecedented run on nickel caused a short squeeze. Manus, last week, the jobs report for February came in better than expected, which makes some think maybe this emboldens the Fed to raise interest rates faster. With all the stuff that we've got going on right now, is that even possible?
Well, it really was a Goldilocks report. In normal times, there would have been a lot of attaboys and backslapping after those numbers. Normally, the jobs report would be the center of everybody's attention. It would have been really the focus of 2 hours of commentary on CNBC after the report. But with everything that's happening in Eastern Europe, it was really just a footnote for the week. That being said, what did we see out of that report? Substantially higher job numbers than we anticipated, than the market expectations had been. We saw only modest wage growth, much less than what was expected. And we saw a slight uptick in workforce participation. So in terms of Goldilocks, right, what does this show us? This shows us a rebounding US economy without inflationary pressure, but with more people coming back to work. If you're a CRE guy, a landlord, an owner, you loved this, right? But again, in the context of everything that was happening in the week, higher oil prices, the horrible images coming out of the Ukraine and everything else, it was just quickly forgotten. And the markets just continued to sell off after that jobs report came out. But it was an incredibly busy week of economic data. That was one major point. Major point two was today's CPI number, which came in just a tick over what people were expecting. The expectation was for a 7.8% rise in CPI year over year. It came in at 7.9, but the markets really spiraled lower right after that. And it really just shows the lack of conviction investors have right now. Big rally on Wednesday, hope that there could be a ceasefire, markets go up, a bare miss in the CPI number, and everything spirals lower. And that's just kind of shows how little confidence people have right now. The markets did rebound as the day went on and oil continued to fall, but it's hard to have any level of optimism about where we are today. That being said, back to your original question, does this embolden the Fed? I think not a chance. I do think that there's an interest rate hike coming, but I think that there's no chance that they get aggressive with a 50 basis point hike. If anything, it's a 25 basis point hike with some dovish language, which says, we're going to see how this goes, right? With no commitment to when the next one comes and how quickly interest rates will go up. I think they know the US economy is fragile and they're concerned about slamming on the brakes too hard. That's my guess.
Yeah, it's interesting, Manus. I remember the days when we look at a jobs report and that was the headline fodder for that week. Now it's just lost in the commotion of everything else that we're seeing at a macro geopolitical level. So the market doesn't really even use that as a proxy now. So I had a couple of bullet points that I wanted to go over, just some things that I saw this week. So with the CPI number and the sell-off tied to that, a silver lining in that is that auto prices have started to ease a little bit. So we've seen some of this run up in auto prices over the last couple of months, maybe start to hit a peak and come down. So maybe there's something good coming there. Gasoline prices up seasonally adjusted 6.6% from the previous month, which is about an unadjusted annual increase of 38%. There was some good news in addition to just the job report. Particular industries, hotels, restaurants, amusement parks, and other hospitality industries led the way in hiring. So I think that speaks to a growing number of vacationers, convention attendees, and business travelers. So we're starting to see those markets come back. And then on the gasoline front, the average price of regular unleaded this week was $4.25 a gallon, which is just really high. President Biden's facing calls even from his own party, to suspend the federal gasoline tax. They've already made a couple of calls to the strategic reserve to try to ease supply issues. And if you look at what our imports of crude oil from Russia is, around 8% of our total crude oil. So I think those things are going to have to get ironed out. Those things are going to play out. The Fed's going to be cognizant of all of that when they're making their decisions. And I think for us, like, we're living in a day-to-day environment. I mean, it's not every day that you see prices going up the way that they are related to gas. I've been traveling this week for work. There's still, even with the jobs report, it's hard to get service at fast food restaurants. It's hard to get service at hotels because they're just understaffed.
It is interesting, the whole gas thing, to me, because there's such a regional element to this, because so much of what you pay for gas comes down to what your state tax is. Here in South Carolina, where I am now, gas is still in many places in the threes, the high threes, but still in the threes. If you look at what you see on the news reports, just like the weathermen always are looking for the highest amount of snow we're going to get in this current blizzard that's coming in. The guys on TV show the gas at $6.99 a gallon in California. But part of that is true. But part of that is a function of state taxes, which means that in some areas it'll be more painful than others, right? In some places you're going from $4 to $6, and in some places you're going from $2 to $4. And I think that will impact, some areas more than others. A couple of other bullet points from this week that I wanted to bring out. Martha touched on one, which was the big nickel short. We had a big Chinese producer, which was on the wrong end of an $8 billion short. Longtime listener and friend, Donut Shorts, sent this to me, an article that they had seen really at the cusp of this. And I think it was before any of this news hit. And I guess in a sign of resiliency, the fact that didn't rattle the investment community more was a good sign, right? We also saw the Peabody Energy margin call, which also happened this week. Normally, events like this start to make people think, who are these firms that are on the wrong end of these shorts creditors to, right? Which banks or which financial institutions, non-banks, are they going to stiff because their losses are huge? And when that happens, that's when liquidity really starts to dry up. And when that happens, lending slows down or stops, and the markets start to get panicked. We didn't quite see that this week. That being said, I will bring out another point, which Donut Shorts also tweeted at me today, which is a Bloomberg story, which I thought was very interesting. Their claim is that junk spreads are soaring. Double B, single B, triple C spreads are blowing out because people are really concerned about credit risk. But it is being masked because a lot of sub-investment grade debt is held by energy companies. So while the energy companies are seeing their debts tighten, everything else is blowing out. But on average, it doesn't look that bad. And what Bloomberg's story is trying to get around is usually double B spreads blowing out is an indicator of credit events coming and a recession on the way. And if this energy stuff is masking bigger problems, then some of this complacency that we see, which includes us, because we say so far everything's been fairly orderly, might be an illusion. And that's something to watch. What we need to do is get our resident expert, Andrew, who's been a guest on the pod many times, Andrew Jacobs from Trepp, back on the pod to really give us, because he is a data dog when it comes to junk debt.
So I'll just end on this. I think as a preview to some other topics we're going to have today, we'll go ahead and put up the bat signal for Andrew to heed the call.
That's cute. Well, I want to play off something, Manish. We were talking about inflation, and it was almost instantaneous when the inflation number came out today. Analysts were already predicting what it was going to be next month, because obviously this month's number is before the invasion, right? Before you saw all the turmoil in the last couple of weeks. So there's predictions that it's way north of 8%. So how does that play into consumer behavior and other things?
That's a great point, number one, because this run up in gas and other energy costs is not really reflected. This is a February number, the CPI number, right? So we haven't seen the impact of $130 a barrel oil just yet in that CPI number. So I think those analysts and your instinct, Martha, your instincts are quite spot on. How do consumers change their behavior? Well, historically, when we've seen periods like this, the go-to example is the parents that are used to buying steak once or twice a week start buying chicken instead, right? Instead of paying up a higher price for beef, they pick a cheaper source of protein to keep their household costs in there, right? That used to be the excuse for people saying, even though CPI is high, the consumer will not be buried because they will transition from one cost to another. What does this mean for the CRE assets? I think, a similar example that people have been given in the past is that rather than going to a high-end casual restaurant, people trade down, right? If they're middle income, maybe instead of going to Applebee's on a Friday night or an Outback, right, you're picking up Subway or pizza or something like that. The same might be true for the hotel business, which is we're going to still take the family to Disney, but we're not going to stay on the premises. We're going to stay at the Hilton off premises and save some money because the travel expense is so high. The thesis is this does benefit the middle to low end proprietor because high end spenders come down the curve to fill in whatever loss they get from low end spenders. Time will tell if that's true here.
Yeah, it's really interesting, man. If you look at, as Martha mentioned, the numbers today did not reflect the invasion, but some companies that decided to pause operations in Russia, which have roots in the US, which these costs will eventually be absorbed by US consumers, is McDonald's has temporarily closed all 850 locations that they operate in Russia, but they're continuing to pay the 62,000 employees that they have on staff there. It'll do the same for the 100 restaurants in the Ukraine. So together that represents about 9% of its global revenue. So they're going to continue to lose revenue while, offering pay and compensation to those employees. Those costs have to be absorbed somewhere. Pepsi's looking at options for its Russian business, writing off its value. They suspended soda sales in the country, which is its third largest market. So those lost revenues are going to have to be made up somewhere. In terms of consumer spending or habits, I think at this point, the sentiment has still been fairly positive. So we haven't seen a shift in the overall sentiment. So the gas prices are what we would call sticker shock because that's what everyone sees when they're driving their car every day and filling up every 2 or 3 days. But if you look at what the average spend is on gas, it's only a small share of consumers' overall spending habits. It's just that they're visible. And as you said earlier, Manis, folks can find photos and scare people at nighttime with the $6.99 a gallon. Gas prices, though, could be a catalyst to change the sentiment. If they continue to rise, if we get to an average of $5.50 or $6 a gallon, then maybe that sentiment overall about the economy and where we're headed starts to shift. And we saw with the great financial crisis, when the subprime lending crisis was taking place, a lot of consumers still were bullish. When Lehman and a few others started to falter and it became a larger issue and that sentiment shifted overnight, spending habits changed immediately. So I don't know that we've hit that peak at this point. I think it's something that we should continue to keep an eye on, and it's definitely not going away. Everyone's wanting to talk about inflation. Everyone's measuring it, and we're all feeling the impacts at different levels.
There's another area that could benefit B and C apartments, right? If you get this Class A rental increase inflation, which has been substantial, paired with higher gas costs and other inflationary factors on utilities and so forth, that may accrue to the benefit of B and C operators, where people say, you know what, we're paying $1,600 a month. There's a place that's kind of similar right down the road that's only $1,200 a month. Let's look at that place. Let's see how that does. It'll be interesting to see how that dynamic plays out there. A lot of it is a function of how long this lasts, and that'll be a big part of it.
Last week, we talked about a couple of CMBS deals that appeared to be pulled, but we've got some further color on those. And the question is, were they pulled or were they simply paused?
Well, I'm going to give a little bit of inside baseball on that. I went back to the Trepp modeling team, which is it's a team that I grew up through during my formative years and helped build a lot of models back in the 90s and early 2000s. And these are the cash flow models that people use to trade bonds, to predict how bonds will perform under various default and prepayment scenarios. I went back to some of those team members this week to say, we've seen the stories about deals being paused. What exactly does that mean? And here's the color I got. Hopefully I'm relaying it correctly. 3 of the deals that were reported as being paused were deals that we had yet to see. They were not yet on the tarmac. They were not ready for takeoff yet. So this was not a case of deals being paused. It was more a case of the dealer saying, or the borrowers, we're going to wait for more favorable times. 3 of the deals are kind of in that period between the borrowers saying, having seen the preliminary model, but not having priced yet. It seems like the issuers have tapped the brakes, but nobody has pulled a deal yet. They seem to be waiting for a more favorable time to launch these deals. So I should add 2 things. One is that all of these are single asset deals. We haven't seen a conduit come through in about 2 or 3 weeks, which may be telling. And on the other side of the coin, I think we saw a deal price today. So some good news, some bad news in there. I'll let Lonnie weigh in for a second here, and then we'll update where spreads have moved in the last 30 days.
Yeah, so I think it's interesting to point out that these were SASB deals. So as we know, those are probably a little higher concentration risk, either single asset or similar assets spread across, a couple of different geographic regions and assets specifically. I do think we've modeled, we're still getting new deals to model every few days. So while there's caution, the conveyor belt, as you mentioned, Manus, hasn't totally stopped. There's still planes on the tarmac. So in 2008, we hit the brakes, pulled the emergency brake, all the airbags deployed. Everyone was stuck until the tow truck got here. That hasn't been the case here, but I think it just speaks to the broader macro scenarios we've been discussing on the last couple of weeks. Like there's just a little bit of concern, and so people are not going to take what they view as potentially unnecessary risks. If things shore up in Ukraine over the next couple of weeks, I would say the market would be primed for a rebound in terms of these things being issued.
Updating people on spreads, where are we now? I had our pricing team here, which is the group responsible for putting marks on about 25,000 bonds every day for mutual funds and so forth, where spreads have gone since January 31st until yesterday. It seems like in the conduit space, we are about 30 basis points wider, give or take. In the BBB minus space, depending on the quality of the collateral, how dented a deal is or how well it's regarded, we're probably 75 to 90 basis points wider. So if you're trying to price a deal today, you're probably talking about an all-in cost that is, but for argument's sake, 40 basis points wider, 45 basis points wider in terms of total cost of your deal than where you were 40 days ago, right? The middle of the curve, those double A's, single A's priced 60 basis points wider. That being said, it would not surprise me on the lending side right now, to the extent that issuers, conduit issuers are lending, they're not charging you 45 basis points more than where they were 6 weeks ago. They're probably at 90 or 100 or 120 basis points wider. And that's because they're not trying to thread the needle here. They're not trying to keep up with how many basis points of spread move we've seen. They're trying to immunize us against another 40 basis point move. And so even though bond buyers are only seeing 30 basis points of widening at the AAA level, I would say borrowers are probably seeing substantially higher quotes for certain property types than that at this point.
Yeah, I think that'd be interesting for some of our listeners to maybe send us some deals that they had priced that maybe didn't come to the table and what they look like now if they have them repriced. It'd be interesting to see what those costs have done in real time from the market's perspective.
I mean, we're really talking real money here. If you're saying that the 10-year has gone from 1.5% to 2%, that's 50 basis points. And if spreads are being quoted 75 to 100 basis points higher, right, that may be on the high end of what we're seeing. That is 150 basis points wider for some property types and some properties than what we were seeing, 2 months ago, 3 months ago. That's real money.
Digesting all of this uncertainty made a bunch of us on the research side ask the question, back in 2016, when risk retention was initiated, how is it that it actually either helped securitized loans be safer or potentially didn't? So we actually had our team, Max Nelson, look at what that looked like in specifics, looking at delinquencies, both pre and post risk retention, to give some insight.
So if we haven't lost every landlord and every non-CMBS player at this point, we may kind of put the final nail in the coffin with this next part. I'll try to be brief on this. Coming out of the great financial crisis, regulations were passed that forced issuers of securitized products to keep some skin in the game. They had to hold on to some of the risk of the things that they were securitizing, 5% in the case of CMBS, to essentially prove that they were willing to eat their own cooking. The thought process was, in 2008, people were making loans that they never would have held on their own balance sheet, pushed them through the securitization sausage maker, and basically foisted that risk on other people, holding none of it themselves. Regulators coming out of the great financial crisis put in this rule called risk retention, which forced issuers to hold on to a portion of these loans, 5%. And in the early days, as we were running up to risk retention, there was a thought that this might doom the CMBS market, that people may not want to hold on to that 5%. There was also a function of that rule that said B-piece buyers, those that bought the sub-investment grade bonds of CMBS conduit deals, had to hold on to these positions for at least 5 years and have certain financing levels that made sure that they were going to be in business for the long term. In fact, the 5-year was really a 10-year window, because if you were going to sell it, you had to find somebody who was equally deep-pocketed to sell it to. The people that buy these bonds now are sophisticated financial institutions like KKR and Square Mile and others. There's about 8 or 10 of them that buy these things. At the end of the day, the market survived largely because AAA investors liked the fact that these dealers were holding skin in the game. They felt like that fact would make the pools safer, and they felt like the B-piece buyers would be even more focused on the credit. And therefore, AAA spreads on the new stuff post risk retention, which kicked in essentially 12/31/2016, would be better deals. I think the data shows that, and we'll get into that in just a minute.
Yeah, I would say this is one of those times where regulation or new rules actually made the process better. It probably leveled off some of the pools. When you have skin in the game, you pay more attention. So I know you and I talked before the pod, man, is the B-piece buyers do actually get to see the pools before they retain the 5%. And they have some ability to retrade or ask the issuers to kick certain deals out. And so, maybe this process just got a little more, sunlight shined on it, and it actually has been a net positive for everybody involved in the transaction. I think we have some details here we'll share in terms of delinquencies and how the properties in these deals post risk retention have performed, which would support that. But I think just from a general perspective, this is one of those things that everyone thought was going to tank the system, which is kind of funny if you think about it. Maintaining your interest or holding a percentage of the deal that you're bringing to market or buying as a B-piece buyer, when that scares the marketplace, maybe there's some problems there. But the fact that this actually has made the process more efficient and more fruitful, I think, is actually a testament to the validity of this challenge.
Yeah, to your point, Lonnie, it's like revealing, like restaurants being forced to reveal who eats their own food and who doesn't. And you're thinking that once we get to the point where these guys have to tell us if they're eating their own food, the whole restaurant industry will stop, right? The hand-wringing that went on in the years before this took place is just kind of absurd when you look back, right? Although I would like to know, I'd like to see that as a metric in restaurants, right? Who's eating their own food and who's going to the guy across the street. That would be a nice service for some data provider to start. Jumping into the numbers, across the board, the post-risk retention delinquency numbers are extraordinarily better than the pre-risk retention numbers. Some of the bigger, most obvious distinctions: lodging, 13.6% for loans before 2017, 6% for loans after 1/1/2017. Office, 4.2%, risk retention, 1.3%. Retail is the biggest one, and we'll get into that in a moment. 11.7% pre-risk retention and 1.4% post-risk retention. These risk retention numbers are as of 12/31/2021, so they're as of the 5-year anniversary of that legislation.
Yeah, it's interesting to look at these though from a contextual perspective, man. As you know, the more seasoned the loan pool is, sometimes the troublesome loans actually start to show themselves. So the strong performing loans backed by good properties pay off or refinance, and the weaker loans that remain longer term, start to show some of those things later on in the cycle. And I think for most of these deals, a lot of the post-risk retention deals are less than 2 years old. So they haven't really had that seasoning component added to the mix. But I think the numbers are so different that even if some of those, start to rear their head, we're not going to get anywhere close to the numbers that we had pre-risk retention.
That's certainly true. Lonnie is a professor during his very valuable and limited free time. He's a professor at Texas Tech. Is that right, Lonnie? Give me the nod. I got that right? And, we talk about this, the fact that the poor performing loans stick around and the good ones refinance as properties are sold, or, the properties are refinanced into lower rates or something like that. It's called adverse selection. And it's kind of like at a college where, if you were looking at kids that matriculated in 2017 and you saw what the average GPA was of those kids in 2020, of all 4,000 students that began in 2017, it would be X. If you looked 2 years later, it might be like 0.7 of X, because all of the good students graduated on time and all the guys that needed a little extra time and had lower grades, right? They stuck around. And that's what you talk about with adverse selection. I'm talking about it from a position of strength in that case. I know from where I come. One other point with those retail numbers, it was beyond just adverse selection there. 2012 and 2013 were the golden years for CMBS issuing mall loans. Golden years in that they did a lot of them. It became kind of the toxic years for the deals that they were securitized into. But by 2015, the joke was realized that these malls are all, or many of them, are going to tank, and there was no lending in malls after about 2014. So even without risk retention, the mall delinquency rate from 2017 to 2021 was going to be better, just because of CMBS issuers not lending on mall debt anymore.
If you are interested in looking at the comparison data of pre and post risk retention, send us an email and we will send that over to you. It's worth a more detailed look than we have time to probably cover here. So let's turn to some property sectors. We've got a number of good stories across multiple property sectors. Let's start with office. We've got green shoots. It is spring in my mind anyway.
Yes, we don't know precisely how the office market is going to play out. It's a source of a great deal of debate. Will valuations hold up? Will people come back to the office? The Castle numbers that we refer to still show several markets I think there's 2 markets now still under 30%. That would be San Jose and one other, could be San Francisco, under 30%. Several others still in the 30% range, 30 to 40. So the question is, would they hold up? And we saw several stories that I would highlight here that were pretty good. At the end, I'd love to hear Lonnie's take on the Dallas office market. The first green shoot, this came from the Dallas Morning News. The Trammell Crow Center in that city sold for more than $600 million. It's a 1.1 million square foot asset on Ross Avenue The price equates to $532 per square foot. For me, this is noteworthy because that downtown area has had a lot of big sublet announcements with companies in downtown Dallas moving to other parts of the city, similar to what we've seen in Chicago and New York. So seeing this get a premium price was a great green shoot. I believe the Dallas Morning News said this was the second highest price overall for a Dallas downtown office at $600 million. The second one I loved was out in LA. There, Castle Systems says about 37% of employees are back to the office. There, the Lincoln Property Company and Angelo Gordon have put the Warner Center back on the sales market. Why did this one catch my attention? Well, this was offered for sale and there was a handshake in place to sell this for $211 million right before COVID. COVID comes, the deal unravels, the property doesn't get sold. Greg Cornfield of Commercial Observer reported that they are asking now $210 million. So a very, very fractional reduction in the price. They're hoping to get basically the same amount that they were getting pre-COVID at a time where office occupancy is less than half of what it was the last time they had a handshake. So that would be a bullish sign that they could still, if they still get that price. The last one I'll throw out there in St. Louis, this comes from Gloria Lloyd, who we mentioned last week, St. Louis Business Journal. The Centene occupied Timberlake Corporate Center has been acquired by Glenfield Capital, $67 million. We've mentioned before the St. Louis market really hard hit by vacancies, sublet space, and falling values. This is in the suburb of Chesterfield, so it's not in the city per se, but it is a very nice price for an asset there in a market that can use some positive comps.
Yeah, so I think before I kind of comment on the stories there, Martha, we need to get a title sponsor for these green shoots and crabgrass. So it's spring season. Maybe we need to get some sort of sponsorship going on for these segments.
Scots, right? The obvious.
Scots, exactly.
Royal turf.
They ventured into the CRE business. So let's talk about the Dallas market first. So I think, as you mentioned, the Dallas Morning News said this was one of the record-setting prices. So again, Haley might be able to get our cashier sounder going on this. It's not the only one, though. The Crescent, which is a large office hotel, mixed-use center in Dallas, actually transferred in 2021 for $655 million, which was about $500 a square foot on the contract price there. So Dallas has seen a couple of really large office type of anchored complexes sell for that 500 plus per square foot value range. And Dallas has historically seen some challenges with some of their premier office buildings on a relative basis. So they have a lot of corporate headquarters here. There's a lot of bank buildings in downtown. And those things have traditionally not traded at a premium price. And it's interesting. The summer times are very hot in Dallas. There's not a lot of ground floor retail. And so those buildings struggle a little bit relative to some other markets that maybe have a little more temperate climate from a sales price perspective. So in Dallas, they actually have a tunnel network. So we don't have really subways or anything here in Texas. But in downtown CBD, there's a tunnel network and there's a lot of sub-ground floor retail space, but the retail on the level, street level, is not great. So it's good to see another property trade at 500 plus. If we look at the Lincoln property story, again, I think that's a good sign for the marketplace that they really haven't taken a haircut on this newest listing. I did want to mention that there were some pretty good tenants in that space. Anthem anchors the space. They have 169,000 square feet. Activision Publishing, which was part of the Microsoft acquisition of Activision Blizzard, has 90,000 square feet. And then other tenants there include WeWork and New York Life Insurance Company. So even though the market had some turbulence with COVID, those are some good credit tenants with long-term leases in place. And then just on St. Louis, I'll just finish by saying we've kind of been beating St. Louis up the last couple of weeks with some negative stories. So it's good to see that an office there sold for about $200 a square foot. So good to find some green shoots in the St. Louis market.
Yeah, I'll go back to Dallas for one moment. I have a bunch of buddies, some of whom listen to this periodically, that are flying down to Dallas this weekend. The Rangers are playing down there. They're big hockey fans. They decided to make a long weekend out of it. Check out the game. We also have some mutual friends down there that are all going to get together. And my word of caution is if you run a restaurant down there, get paid in advance. They tend to run up big numbers.
Turning to hotels, we had a couple of interesting stories there.
Yes, one crabgrass and one green shoot. I'll start with the green shoot. This is from Crane's Chicago's A.D. Quigg. In Illinois, a bill has been presented that would give hotel owners a one-time stipend of $1,500 per room to help the industry recover from COVID-19. The funds would come from unspent American Rescue Plan monies. The total would cost the state, wouldn't really cost the state, the money's already been paid for, $250 million, which would be a nice shot in the arm for that part of the country. Chicago hotels, there was a glut of them heading into COVID, really painfully hit by the lack of business travel. And one of the most troubling hotel markets in the US, certainly one of the most troubling large markets in the US. So help may be on the way, but of course that bill has to make its way through the state legislators first.
You're not understating some of the losses there. And I know we have some of those numbers that we can talk about, Lonnie.
Yeah, so Michael Jacobson, President and CEO of the Illinois Hotel and Lodging Association, said that throughout the last 2 years of the pandemic, Illinois hotels have lost about $5.5 billion in room revenue. They don't see that getting better immediately. So Chicago has been one of the hardest hit hotel markets, and we've actually seen a lot of hotel to multifamily conversions. We've seen a lot of hotels being considered for secondary or alternative uses. And so I think this is maybe a great first step, but in context, it's a very small, shot in the arm on a relative basis, considering what they've lost over the last 2 years.
Right. This may move the needle for those ones we call cuss people, right? Marginal performers where the guy is not sure about whether he wants to throw in the towel or keep it going, right? This may be just enough to keep some of these custody guys in the game in Illinois. And hopefully they do, because I'm always rooting for these guys.
Yeah, I think about 40% of the hotel jobs have been lost since the start of the pandemic. So it's not just the operators that are feeling the pain here. It's a lot of the workers that were previously employed in the hotel industry in that market.
Yes, and that reminds me, I like to give shout outs to different categories. Please be generous if you can be with those tips when you're leaving the hotel for the cleaning staff, right? They're operating with less help than ever before and fewer tips than ever before. And that $5 or $10 that you leave on the nightstand is, I'm sure, a nice thing for them to get. And we need them. We need them to keep our economy going in so many different service parts of the economy.
And we had a crabgrass story that brings us back to New York.
Yes, I've been fortunate to go through almost all positive stories thus far. This was kind of a real piece of crabgrass there. Is there something worse than crabgrass? Like maybe bamboo. You ever try to get rid of bamboo, in your backyard? It's like
invasive.
It's invasive and it's backbreaking to try to deroot that stuff. Anyway, the Real Deal, citing a Green Street report, noted that the Sheraton New York Times Square was sold for just $200,000 per key to hotel operator MCR. The hotel has 1,800 rooms. It sold for $356 million. It was acquired for $356 million from Host Hotels. The property last sold in 2006 for $738,415,000 per key. So for New York hoteliers, lenders, this is just a brutal comp, right? When you're trying to figure out, what can I get for my hotel? At this point, this is just a really negative headline. We hope that this is an outlier.
Yeah, this is one of those stories that you see and you walk away saying that's going to leave a mark. Just not great news.
And let's finish off with some retail news.
Well, we have a lot of retail stories, but we're only going to touch on one today. This was in Santa Monica. We saw a movie theater there sell for almost $27 million. It's unclear how much demand there will be for in-person movie experiences coming out of COVID-19. But at least in this case, in Santa Monica, somebody was willing to pay a sizable price. It's the AMC Theater on the 3rd Avenue Promenade, sold for $652 a square foot. That's according to the Real Deal. and I always like ending on a happy note.
We actually have a lot of really good theater data in the Trepp data set. So if you're looking for lease comps for AMC, Cinemark, rental rates, et cetera, like that's something that we're very data rich in. In fact, we had a research report a few months ago that Darren put out that highlighted some of the exposure for theaters, across our data set. So it's good to see that there's some positive news there.
Last weekend, Batman opened. Speaking of theaters,
Batman the movie landed 134 million in North American theaters. What was really interesting here is AMC theaters and other major chains were actually charging $1 or $2 more than other movies playing at the same time. So maybe this is a new pricing model or surge pricing. They've been watching Uber and Lyft and these other companies capitalize on surge pricing. And so when they have something released, they're going to fully capitalize on that if they have moviegoers that are willing to come out to the theater. So if you're going to see a B+ movie, maybe you're going to get a discount soon. But if you're going to see the A+ movies, you're going to have to pay a premium.
Listen, if I'm going to see a Ben Affleck movie, which would not be by choice, it would be because one of my kids forced me to see it, or a David Spade movie, even better, I want at least a 75% discount. If we're going to go to variable pricing, I'm okay paying more for something good and exciting, but I do want that discount for something schlocky.
so how about what would you pay for Ben Affleck as Batman, which obviously did happen?
No, like that's a rough one. I mean, they might have to like pay me to go see that. I don't know. Like that's, it's like getting negative treasury yields, right? It's you're going to get me in the door. I want to go for free and you got to feed me.
If Ben or Dave's PR or publicists are listening to us, please don't hate us.
I'm going to give Ben Affleck some credit in the meme game with him and Jennifer Lopez is pretty solid. So his movies, maybe not so much, but the Ben Affleck on the memes, pretty solid.
But before somebody comes back to us, I want to leave one more point on the movie theater with that $652 a square foot. I didn't look at the data. That may be low by historical norms, but all of these property types we measure on a curve when we come up with our crabgrass and green shoots, right? On a curve, the question was a few months ago was, will any movie theater be sold? Will they be coming back at all? So if people come out and say, well, these things were selling for $900 a square foot, 2 years ago, and this is a real deep discount, that may be true, but I do measure my crabgrass and green shoots on a curve, especially for hotels, retail, and other experiential property types.
Turning to shout outs, we have a number of shout outs. Manus, I know you had a few.
Yes, I had several shout outs this week. Donut Shorts, who I mentioned before, JS, a college student that has been liking a lot of our Twitter content and has been sending likes. I hope you're learning from what you're listening to. A host of Clemson students, which is near where I live currently, have been checking out our podcast. Thanks for listening. Really happy for that. And I'll throw out one more. This gentleman is a longtime listener, longtime friend. I'm not going to give the initials or the name. He has been urging me. If you remember, a year and a half ago, we did a brief segment on the best songs ever and the worst songs ever. And he urged us to do a piece on the greatest heavy metal music ever, live performances. And I thought of him this week because I went to 2 different record stores down in South Carolina. And in one of them, I found an album from the band UFO, which is the Michael Schenker guitarist who is just through the roof. So in his honor, I had to pick it up, but I can only play it when my wife is not in the house. It is so heavy, heavy, heavy metal and so guitar centric that my wife put her foot down and said, we are not listening to that again. So for our longtime listener who loves his heavy metal stuff, that story is for you.
And how am I going to figure out who it is without initials or any other identifying characteristics other than this music? I think I just play it and maybe he'll show up. I don't know. I'll try that. A couple other shout outs. Chad C. in La Jolla loves the podcast. Johnny G., otherwise known as Key Lime Johnny, corrected Manus's pronunciation, and we're not above correction if needed. The town of, spelled like Dunedin, is actually pronounced Dunedin. And I can't explain that, but that's apparently how it's done, according to John.
So John's email this week, it said nothing more than, I think I was pronouncing it last week, Dunedin. And he was saying, I was saying Dunedin, and he said Dunedin. And I went back to him and I said, they should really fix that. They should, why should I have to change my pronunciation?
Make it right. Erin T shared the details of her University of Florida visit at the conference and even shared a snap of her TreppWire Podcast cap. So thank you, Erin. Lucius sent in the work from home sucks. Sorry, kids, if you're listening, that's not my words. That's Lucius's words. Long live the office. So obviously he's happy to be in the office. Two more. Christea retweeted our episode 126 tweet, and a thank you for all the listeners we have. We've actually hit a good milestone. We've got on average 20,000 listeners per month, which we've never would have predicted. There's 20,000 people that would be interested in the content that we talk about weekly, but apparently there are, and we can't thank you enough for your listenership and your engagement.
I would say that we'll never reach Joe Rogan's numbers, but he will never reach the quality of listener that we have. The thoughtful emails, people coming to us with data, analytics, commentary. It is just really a situation where I do feel that I get more out of what I hear from our listeners through Twitter, through emails, through phone calls than I do give them in commentary. So, man, we got a great audience here.
Yeah, the podcast, I think, is the highlight of our week. So we love putting it on and we love seeing people enjoy listening to it. So it's a really great feeling.
With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.